So now we will move to one or two more questions. These are it is an important question. We will do later sometime. Now I want to go through this question because this is the question several times asked in the examination. So these type of questions are asked. Liquid ratio or acid test ratio of PQR limited is 1.5:1. State with the reason. You have to also mention the reason. The impact on the ratio if following transactions are undertaken by the entity. So if this entity PQR limited undertakes following transactions, then what will be the impact of the transaction on this ratio? That is the question you have to solve. So purchase of fixed. So first of all, I think we need to write here a balance sheet. I will prepare just to go. It looks very awkward. See, so I will write here. Prepare a balance sheet just to go through this one. That's so here you will see in a T format. I have already shown this. Share capital is there. This is the liability side of balance sheet, and this is the assets, and this is obviously a balance sheet format of an entity. So this is your amount is this. Share capital is given here. That is your non-current liabilities. Okay, this will come here. Then your current liabilities. Why I am going through this? Because that will help you to understand the impact of transaction on the ratio. See, now this is your current non-current assets. See, and now here is your I will write it differently. Inventories are here, prepaid expenses are here, and then there are other these are also the current assets, but I will write it differently because you know that will help you to understand the quick ratio or quick assets. So other current assets, or I will write it other current assets, so you don't get confused. Okay, so what is the point to go through this is that you have to see that whether which item of the balance sheet is impacted by a particular transaction. So now the purchase of goods of rupees 1 lakh on credit, that is means the inventories will go up, and now here write quick assets upon current liabilities. See, that is okay. So inventories, now the first is purchase of goods on credit. So inventories will go up and current liabilities also will go up because, but here in quick asset we do not include inventories. So in this will remain as it is, no change at all, but current liabilities will go up. So the impact will be that the ratio will go down because this quick assets remain same, but current liabilities are increased. Fixed assets sold for rupees 50,000 cash. Here what happens? Current assets, non-current assets will be reduced because we have sold a fixed asset for 50,000 rupees, and that is included in in quick assets. So quick assets will increase, and there is no change in current liabilities, and there is no impact on quick ratio of sale of non-current assets. So therefore what the remains is that quick asset will increase, there is no change in current liability, the ratio will go up. You have to write the reason. Debenture of 5 lakh were repaid by issuing equity shares. So see here, debenture means non-current liabilities, these are reduced. And how they are reduced? By paying to debenture holders by issuing equity shares. So and that is non-current liabilities. So there are two items of balance sheet here. One is share capital and other is non-current liabilities, but both of them are not included here. So there is no impact of the ratio, that will remain the same. Now machinery book value 50,000 was sold for cash, but cash not received. Cash not received, you have to write an assumption here that we assume that the cash will be realized in the next 12-month period, in a short term period. So in this situation, there is when a machinery is sold, so that non-current asset will be impacted, but there is no here no item of current non-current assets are included, so there is no impact on quick assets, but cash is there. Therefore the cash, we assume that the cash will be realized in the next 12 months. So in this case the quick asset will increase, but there is no change in current liabilities. The overall is the ratio will be increased. Debtors of 25,000 declared bad and nothing could be realized from them. Now debtors are here. So debtors are here, that means the debtors are there, and these debtors are included in quick assets, and quick assets are reduced because debtors are bad debts are there and nothing could be recovered from them. So quick assets will go down, but there is no change in current liability, means current liability remain the same. So therefore the ratio will decrease. And there are last is bill payables of rupees 10,000 was paid on maturity. So that is the important point to note. This is the important thing. The quick assets will go down because the cash has reduced, and current liabilities also reduced because a liability, a bill payables are paid on maturity. Now point is that the ratio, quick ratio we have, the quick ratio given is 1.5:1. So what we will to understand that whether the ratio due to this transaction will increase or decrease, you have to assume that the item is 1,50,000. Any number you can do there, it is only an imaginary numbers, so that but ratio remains the same. So I have taken that quick assets are 1,50,000 and I have taken that current liabilities are 1 lakh. Again I am saying that these are the purely imaginary numbers, there is nothing reality. So you can take any other number, you can take 15,000 upon 10,000 also, but that will reduce this item to 0. So don't take this number, take this number that after the giving impact of the transaction, you will have a real numbers there in your hand, so that you can calculate easily. So I have taken this number 1,50,000 upon 1 lakh. So 10th liability reduced by paying cash. So cash will be reduced 1,50,000 minus 10,000, and 1 lakh of liabilities reduced, and that is 10,000. So it will be 1,40,000 and you have 90,000. So when you find out this number, you will see that 1,40,000 upon 90,000, that gives you a number of here 1.55:1. So the ratio is increased. So in this case the ratio is increased, therefore the answer you can easily find out, otherwise it will be difficult for find out the exact number. So this is the way normally the questions are asked